political economy dynamics, and even though a lot of the technical solutions are out there, the political will to address the problem often isn't necessarily there. And it's also a collective action problem. So it's not just about, a major emitter like the United States or the European Union deciding to make a decision to take action, but it's about every country in the world coming together and deciding to take action on climate change. Because a molecule of carbon dioxide emitted in the United States goes into the atmosphere and affects the whole world. And it's the countries that are the least developed, the communities that are the most vulnerable, that are usually the most affected by the impacts of climate change, not necessarily those that are the biggest contributors to the problem. So what is the world doing about climate change? Well, you've probably heard about the UN Framework Convention on Climate Change. This is the main global body that that collectively brings governments together to respond to the challenge of climate change. It was established in 1992 and has been holding annual meetings called Conferences of the Party or COPs. Every year since then, except one that was missed during COVID. And the Paris Agreement that you've no doubt heard about is one of the big milestones that was agreed under the UNFCCC. And what this Paris Agreement does is, firstly, it sets a goal to keep global warming to 1.5 to 2 degrees above pre-industrial temperature levels. And then it has a goal to align financial flows with low carbon climate resilient development. So if you remember that diagram I showed at the beginning, where you see the climate compatible flows of finance are a drop in the ocean of the overall financial system. The Paris Agreement aims to shift that to get more consistency between what we value as a society and where we put our money. Now, what the Paris Agreement does, and you may have heard about the Kyoto Protocol, which came before the Paris Agreement, and that set goals for developed countries to reduce their emissions of greenhouse gases that cause climate change. What the Paris Agreement does is it doesn't set specific goals for specific countries, but it rather gives every country the chance to set its own goals. Now, what that resulted in was often lauded as a triumph of multilateralism, because the Paris Agreement succeeded in getting all countries on board, which has never been done before in the global climate agreements, and then the Kyoto Protocol didn't include all countries, which was one of its biggest weaknesses. But as you can imagine, if countries are allowed to set their own targets, it doesn't necessarily mean that the world will achieve that 2-degree goal that the Paris Agreement sets. And that is exactly the problem. So countries set their goals through what are called nationally determined contributions, their national commitments to take action on climate change. But if we look at all of the NDCs that have been submitted by countries, they don't collectively bring us to a place where we're on track to meet that 1.5 to 2-degree goal. So although it's been successful as a multilateral agreement in bringing countries together, it hasn't yet reached a point where it's successful in actually combating climate change. And one of the provisions in the Paris Agreement is that every 5 years there is a stock take, and countries revise their nationally determined contributions with the aim of increasing ambition. Now, if we look at the financing of the Paris Agreement, what we can see is that current climate finance flows are down here on the left in the region of, you can see that that number is going up, It's now in the region of about 700 or 800 billion US dollars per year, but it still falls far short of what is needed to reach the Paris Agreement goals. So we need about a tenfold increase in the amount of funding that's being provided annually to address climate change. So how are we going to globally reach that goal? This is a diagram that shows how climate finance flows globally, and you can see that it's quite a complicated arrangement. So on the left here, you've got the sources of climate finance, which include the blue ones are public sources, and the orange ones are private sector sources. And then in the middle, you've got the types of instruments, from grants to debt instruments and others. Then you've got the uses. Adaptation is activities that help communities and economies to respond to the impacts of climate change that are already being felt. And mitigation activities are those that reduce the sources of greenhouse gases that cause climate change. Now, of course, mitigation is extremely important, but for vulnerable countries like Namibia that are not major contributors to climate change, but that are already feeling the effects, adaptation is a much more important priority. But as you can see, the amount of funding that's going to adaptation is less than 10% of the total amount. So it's a very small amount, and that's a problem for vulnerable countries. And then on the far right here, you can see the sectors, and it's primarily energy and transport, which are mitigation sectors. Does anyone here want to hazard a guess as to why adaptation gets so little of the total finance? Any guesses? Yeah.
There's no returns in adaptation.
Exactly, there's no returns. So the private sector is not investing heavily in adaptation because it's not easy for them to make a profit from it. So what we can see is that the sectors like transport and energy, where there's a lot of profit to be made, are attracting a lot of private sector investment. And that's why we're seeing a lot of funding flowing to those sectors. But in adaptation, that's not the case. So that's something that collectively we need to work on to see how we can create incentives for more investment in adaptation. So for Namibia, Namibia is obviously very vulnerable to climate change, and we've seen the effects of drought. We've seen the effects of flooding or erratic rainfall, and climate change disproportionately affects the communities that are already the most vulnerable, including farming communities, people that depend on subsistence agriculture, people that live in informal settlements, people that don't have a source of income that would allow them to find alternative means of making a livelihood if they lose their crops, for example. This slide is a little bit outdated. Triple Capital developed this analysis in 2021, and we're in the process of developing a revised version. But it shows Namibia's climate finance needs. This comes from our 2021 NDC. So it was estimated that it was 5 billion. That has now been increased to 15 billion US dollars. And we did an assessment of the overall climate finance flows in Namibia, which was roughly 10 billion over a 5-year period. 10 billion Namibian dollars. And then we looked at the gaps between the amount of funding needed and the amount of funding that's currently flowing. And we found that for all sectors there are significant gaps, but for some sectors the gap is more important than others. As I said, we will be updating this analysis before the next COP, which will take place at the end of November. So where can this funding come from to fill the gap? Well, there's public sources of funding and there's private sources of funding, as I've mentioned, and different funding sources have different objectives in providing funding. So there's the mission-focused funders, which includes governments, development finance institutions, and so on. And then there's the profit-focused funders, which generally includes commercial institutions like commercial banks, private institutional investors, asset managers, and so on. But then there are also some public funders that are somewhat financial reserve returns focused, like pension funds. And then there are some private funders that are mission focused, like philanthropic funders. And there are different ways of tapping into these different types of funders, which we can go into more detail in the discussion. So why should the private sector invest in climate change? Well, these are a few headlines that have come out in recent years that show why there might be an incentive for the private sector to engage in climate change funding. So, for example, there have been trends that show that ESG-aligned funds can outperform non-ESG funds, especially during times of downturn. So, for example, during the COVID crisis, ESG funds proved to be more resilient than traditional investments. For insurance institutions, for example, there's often an incentive to invest in ESG and climate change investments. Sorry, because climate change poses a real risk to the assets that are insured. So if you don't consider climate change in assessing risk premiums and so on, they could lose out.